I do have the picture.
Hello, everyone. Hello, everybody. I'm still looking at the counter of participants. So we're going to wait a few more seconds before we kick off this first World of Open Account meeting of the year 2021. Just bear with us for a few more seconds. Thank you. Okay, let's get things started, just to be sure that we can keep also within the allotted time frame. And first of all, thank you all for joining us. Thank you for also the panelists and moderator to join us for this first meeting. Normally we do a physical meeting, the New Year's event in London at the LA Piper in 2020 as well. Well, for obvious reasons, that doesn't take place. So we go again to our favorite Zoom tool, which you all like so much, I know, for the year 2020. But who knows, in the very near future, we will be able to meet, who knows, in Vienna in October. But I'm going to hand over, first of all, to John Bressist, who is my colleague at the World of Open Account. And John is going to give you more information about the survey, the second survey we did about the influence and the impact of COVID on the receivables finance industry. John?
Thanks, Eric, and hello, everybody. As a starter to this conversation, we thought it'd be quite useful to talk about the survey that we ran in WOA on the state of the nation in terms of people's reactions to COVID. We ran a survey back in May time this year, and we ran it again in December just to see how people's views have changed. And we thought it would be quite a good way of informing and starting the conversation that we're going to have today. And when I've been through the presentation of the survey results, I'll then pass you over to our host, Steve Box, and the panel, who will answer questions around about the issues raised and the questions that come from the outcomes of the survey. So if I may, I'll share my screen with you and start the presentation off now. So if I may. Okay. So we asked really to try and find out what people's opinion were on the impact of business. Just 10 simple questions to see how the world has changed in terms of the impact of this pandemic. And we compared, as I say, the December situation with that in May. The first question, the obvious one, was it going to continue to impact your business? And you can see that the answer is absolutely, that's the case. And the impact is actually shown there to have grown during the course of the period. So not really a surprise, but you can see the difference in the result between December and May there. We asked if your business volumes had been affected downside, and you can see that there's an issue here that there was clearly a quite dramatic and significant an effect, but the effect was varied. It didn't affect everybody in the same way. Some people have been really badly damaged by this, others have managed to sail through. We asked if the changes that had been put in place in reaction to the first wave were still there, and overwhelmingly, of course, they still are. And I think people continue to focus on the changes in their activities, which are around their operational processes and very obviously the working from home issue. We asked if any further developments had been, any further changes, and you can see that for some people, yes, there have been changes. Others have carried on. They've found that the changes that were made were sufficient, but clearly, again, a balance here. Nearly half of them have really not done anything more than their original adaptations. I think one of the really positive things that we can draw is that we're very fortunate in this industry that there's been no significant impact on employment. We've been able to ride through this, and workforces have, in general, been retained pretty much in full, which is obviously good news for people within the industry. asking about the concern about this second wave. How concerned are you about the future of the business? And you can see that, again, there's quite a spectrum of concern there. But I suppose in general terms, although there's a mix, the majority of people are either sort of middle or lower levels of concern, which again, I think is great news in terms of looking at the confidence, but clearly, of course, it doesn't affect everybody in exactly the same way. So I think the time will tell on that one. But we did say, how does this compare with the 2008-2009 financial crisis? Is it bigger, worse, or the same? And back in May, people were actually thinking that it was really a lot bigger. But as you can see now, people are perhaps not so sure that it is going to be outstrip the effect of that, which again, I think we can take some comfort from. But clearly, there's still quite a high level of uncertainty and confidence remains a key issue for people to develop. Asking them then, well, how long do you think it's going to be before we actually get back to where we might have been before? Where there will be a general recovery. You'll see that the pattern of distribution of time there is almost identical to that which we saw in May. But of course, the reality is that we're 6 months further down the line than that original one. So clearly, people are still seeing that it's, recovery, real recovery is a way off yet in the future. One of the things too that we asked was, in the light of your experience, do you think that, the changes that you've made in your business are actually going to stay embedded? Is it going to permanently change the way that you work? And as you can see there, there's quite a significant majority of people who say that actually it's still going to be permanent. But that figure has reduced a little bit. It was around 85% in the first survey. Perhaps one big surprise, or is it a surprise? I don't know. You decide. The question was, are the interventions that we've seen from governments and central banks into the industry, have they actually been positive or negative for our industries? And you can see that quite the majority of people are saying they're indifferent. And actually, there's a certain amount of opinion that says that the effect has been quite negative or destructive. So clearly, the industry is not feeling comfortable that the central interventions have been positive. So I think that's quite an interesting thing for us to be able to discuss and debate. So very quickly, before I hand you over to Steve, the impact has increased overall. Impact on volumes is significant, but it's spread. Not everybody is affected in the same way. Most businesses have focused very much more on their operational activities and home working, and this clearly continued. Lots of businesses have adapted further, but for many, the first set of changes they've made have proved sufficient. Unfortunately, most companies seem to have managed to maintain their staffing levels and not laid people off. Confidence is mixed, although for most the level is moderate or low. And although many remain unsure, overall they're feeling a little better than they were in May. Little change in perception of how long it'll take for us to recover. And a lot of people think that the changes, whatever the recovery period, are going to stay within their businesses. And despite everything, they think that any of the interventions that we've seen from central government and banks have really been neutral or negative. So I'll stop there and come back. And so what I'd like to do is to pass the baton over to our moderator, Steve Boggs. Steve is Deputy Chair and Head of Origination at Channel Capital Advisors, and he's the founder and Managing Director of his own business, Carter Executive Consulting. He's had a huge experience in the industry, 35 years. He holds a number of NBFI fintech positions, working with a range of companies. You mentioned earlier, Accelerated Payments, Hitachi, OCI, Muse, to name a few. He's also had a range of positions in the past with Falcon Group, with Bibi Financial Services, and head of receivables finance, global head of receivables finance at HSBC. So I think we can say that, Steve, you have some knowledge of this industry. So with that, I'm delighted to pass the baton over to you for you to introduce your panel.
Thank you very much, John. And I always say I started when I was 4. It makes me feel better about my age, but yeah, thank you for the introduction. A great bit of feedback and good insight, by the way, from those World of Open Account members that completed the survey. And really what I'm going to do is try to just focus on those points and pick on those issues a little bit more if I can, with 4 panel guests that I'm delighted have joined us today. I've got Simon, Alessandra, Natasha and Peter, and just a bit of background on these individuals first, because they come with a diverse range of experience. Simon I've known for many, many years. He's the strategic advisor to World of Open Account. He's also working with Blue Compass, operating financial and service models in the invoice finance space, principally across the Americas, and has got many, many diverse experiences at C-suite level in financial services, probably the same amount of time as me, so I won't mention that again, Simon. Alessandra, delighted to be introduced, with 20 years or more experience in the financial sector. She joined UniCredit Bank team in 2007 in the receivables financing space and represents UniCredit Bank SA in the Romanian Factoring Association with the director since its establishment. So it's great to get obviously diversity of jurisdiction as well and some insight as we go forward. Then I've got Natasha. Natasha is co-founder and chief operating officer of Paid. And Paid's mission is to enable all businesses to work better together, smoothing out the slow processes within business with automation and collaboration software for faster payments to the suppliers. And finally, returning from a skiing trip is Peter, creating Seller Group, investing in IT and risk management companies, co-founded Atlantic Risk Management, in fact, who we know well with its German entity, and also co-founded a working capital platform called Liquidatory, and is also, very busy man, setting up a new factoring company in health financing. So just a quick introduction to everyone and welcome for joining. I've got the easy part, it's the questions. You've got the difficult part to give me the answers. So here we go. I guess I'll start with my good friend Simon and say, given the survey feedback we've just heard from John, what's your view of COVID and what its impact it's had? Do you think it's been good, bad, indifferent?
I think it's been varied around the world. We all tend to have a view of our local markets in detail more. I've seen it hugely impact markets in South America. I think it's been very mixed across Europe. I think it had a big impact in the UK in particular. In America, I haven't seen that much impact. Some of the core factoring sectors over there, transportation in particular, staffing, if anything, have kind of kept going. I didn't find factoring sectors over their transport. Sorry, my phone Bixby decided to help me answer that question. Yeah, really mixed. I think we've still yet to see the full impact, and of course the timing of the survey. Different parts of Europe entering different lockdowns again with a second wave, kind of across the world. And so personally, I think we've still got a long, long way to go before the true impacts of COVID have played out on portfolios, both from a new business perspective. Again, different parts of the world, central governments have had massive impacts. I know the UK are best, of course, in that space, and the small business loans program has massively affected the smaller end of the marketplace. From what I hear talking to kind of owners and chief execs of factoring businesses in the UK, I don't think people have been able to do quite all of the physical type risk pieces. So some of the bad debts will still be hidden on balance sheets that we're yet to find as well. So there's going to be more change to business models. everyone's very familiar with the kind of shift across Europe and indeed the world, I think, to online shopping for lots of things when you're in lockdowns wherever you are in the world.
Sure.
And I think some of that will translate into the SME financing world in terms of pushing people more and more towards that. So whether your model can work in an old school face-to-face or entirely online, will have a massive impact over the coming 3 to 5 years as well. So a number of people who have built digital models, who may have found the marketing aspect of that a challenge versus the traditional model, may find that coming around a little bit more as well.
Well, I'm gonna sort of touch on the changes and the business models a little bit later, actually, because that sort of came out in the survey, Simon. But one final question for you, if I can, is do you think, obviously we've got government support, we've got grants appearing, in certain jurisdictions, you've got credit insurance being open by the government, ensuring that they don't close out during an important time for trade to flow, but are we on borrowed time? If everybody then stops providing that support at government level, credit insurers don't get that, crutch of support. Do you see, we're just heading into a massive headwind that's being pushed down the road?
Yeah, all central governments have effectively, what I would say, kicked the can down the road with that level of support. They've had no choice but to do it from a social kind of perspective. How far down the road they've kicked it, in my opinion, it's probably at least 12, 18 months, maybe 2 years. So I still do think there's a lot more to come out of all of this, because no government in the world, I don't care how rich the country is, relatively speaking, can afford to keep continuing to effectively underpin its entire economy. As a result of this, there has to be some winners and losers.
Sure. Thank you, Simon. That's really helpful. And I don't think we've mentioned, but please feel free to post your questions either in the chat room or the Q&A. And what we'll try to do is work towards responding to those at the end of the panel session when we hand over to Eric to facilitate that piece. Can I turn to Natasha at the moment? Natasha, welcome. I guess a couple of questions, if I may, from you is just, how do you see this business environment changing then? And how quickly can it change? Liquidity issues, cash flow issues for businesses may change, stop people accelerating as quick as they would like. But what are you seeing, and what do you think about that?
Well, that's really interesting. Thanks, Steve, and hi to everyone on the call. I think just picking up on the point about cash flow, one of the really interesting things we've been seeing is this sense of corporate responsibility amongst big corporates who do have cash still, because they tend to hold more cash and have, I guess, more certainty of revenue than the smaller suppliers, feeling that they should be supporting their suppliers. So we've had a client who has offered to pay for the faster payment service that we normally provide for suppliers at their cost. So, classic receivables financing. They've offered to pay the fees so that all their suppliers can be paid immediately. And I guess that's why wouldn't they just pay themselves immediately? It's because they're just not organized enough, basically. I think that's really, rather than any desire to have some sort of working capital optimization. So we're really seeing a lot of that, and I get that is something that can happen immediately, and we've seen happening immediately. The other thing we've seen, and that I think is going to be quite prevalent, is big companies wanting to work with more diversity of suppliers. They're in the last 10 years or so, you would have heard a lot of conversation around consolidation of the long tail, and using umbrella suppliers and master vendors. But with the supply chain disruptions that have occurred as a result of the pandemic, the larger companies are feeling a need to have that diversity at the end of their fingertips rather than one step removed. And I guess looking at it a different way, one of the corporates that we work with, they actually said something very quotable, so I'm just going to repeat it verbatim. He said, when something as disruptive as COVID occurs, you need to go the extra mile, both for your clients and your suppliers, And that extra mile doesn't come from other large corporate suppliers, it comes from specialized small companies. So there's desire to work with the more specialized companies. So maybe a step change in the way that you see businesses interacting with each other. The large businesses now needing the smaller suppliers more. So there being a bit of a maybe a change in the leverage amongst business relationships. And finally, I think the obvious, which is that technology has come right to the forefront of every company. Not just companies that are tech companies like we are, I guess, but every single company had to find a way to go from whatever the way they worked before to a fully remote environment. And again, that had to happen very quickly. And I think it will be really interesting to see whether those companies that were not remote first to begin with, whether once we come out of the end of this, when all the vaccinations are through, hopefully the end of Q1 this year in the UK at least, that whether those companies will really go back to the way that they operated before, or whether they'll continue to have that kind of greater flexibility and tech first attitude that they've had to adopt, but by default as a result of the circumstances we're in.
I think on that last point as well, what I would add is it's almost being forced for companies to think more digital because of their own staff as well now. And the natural tendency is for companies to migrate to look at risk, KYC and compliance. But for me, even more so, the client experience, the customer experience has to feature now in that investment strategy as a priority as well. So really interesting stuff. I'll ask you one more question, if I might, just as a short answer, because the survey said that people's confidence of a recovery could vary. And some were saying, even 12 to 24 months, which seems to be quite a lot of time. So if you were to have to call it, what would you say the recovery period would look like?
I think it's so hard to tell because there's been such a disruption in cash flow for so many industries. But we have also seen, there's been a rebalance in some industries, such as technology and remote working industries or remote events. There's been a movement of cash. I would say, I think this year is going to be hard for everyone. Except those that directly benefit from the pandemic. But I truly think that everyone will be making every concerted effort to bounce back next year. And I believe that those companies that do have the financial power still really do feel a responsibility to push everyone towards a recovery. So they'll be spending money to try and help that recovery.
Let's hope so. There's a lot of deposits around at the moment people are holding on to, so we need people to spend, I think, to get the supply chains working again. If I can thank you, Natasha, to maybe Peter, and just ask, what do you see some of the future trends being and are likely to surface and maybe develop over the coming years?
Thank you, Steve. Yes, a difficult question. Over the coming years, or let's say, I will first answer a bit more rather short term, I would say,
sure.
Focusing on 2021. I think what we're going to see is, we spoke about the recovery period. I'm quite convinced that versus the end of Q2 2021, we will see a lot of insolvencies, we will see bankruptcies, we will see job losses. And this is although the government will spend a lot of money, but it will depend on the financial resources of the various governments also. And let's be clear, not all the governments have the same resources. Yes? So we will see a lot of fighting, and we will see a lot of competition also on state level, I think. Which unfortunately I fear will also be seen in a fight regarding the vaccines. I think it will not be as nice and friendly and fair as we would like to have it. And let's say, being in Germany, I'm quite disappointed that Germany, it seems, they're trying to circumvent EU politics and trying to get some, I would say, additional shots for the people. It's not going to be nice. It's going to be rather ugly, I fear.
Yeah, I think it's quite interesting because I think in Germany you have around 207 factoring companies. It's perfect for export-import flows as well to areas like the Eastern European world, Asia. It's really set up well. But I'm interested to see whether all will survive, whether there'll be consolidation, or whether you feel that everyone has the opportunity to bounce back off of an economic growth in Germany.
I think we will have a consolidation. I think we will have some very nice growth of companies that are specialized, that are in niches, that are, for example, in health areas, and we will have the very stable, I would say, companies. They will survive. But I would say the mid camp that are not focused and that are maybe not yet up technology wise to what can be achieved, they will be lost, or they will be integrated by others. When I'm pretty convinced, I mean, Dan Tasha said something interesting also about technology. I'd like to underline and think I'm absolutely convinced that we will see digital platforms that are integrating tokenization, artificial intelligence, and therefore automation in a very appropriate way. And as you say, Steve, also let's say putting forward the client experience, they will have huge growth potentially in almost all areas where it will be put into practice. Practice can be supply chains or financing, but also risk management. We will see, let's say, the risk data that can be used. There's enormous data available everywhere. It just needs to be, let's say, be used in a good way and analyzed in a good way, and so to have some real added value. And we will see technology-wise also that, let's say, infrastructure as a service will become the new normal. It's not really a new trend. It exists already, but it will be like a commodity in the future. There will not be on-site servers in companies. It will just all be internet, I would say. Which means that IT security-wise, a lot of investments have to be made, and people have to think technology much more in the future also than already, I would say.
Very much so. I think not just technology evolution around, as I said before, risk and client experience, yes, but I wonder how in this new world we're going to deal with the challenges of differentiation and forming relationships when everything is, over Zoom, over Teams, and if everyone's doing it the same, what is that point of differentiation? I think that's going to be quite interesting as we go forward. Can I turn to Alessandra if I can? Thank you, Peter, for your feedback. I'm sure there'll be many more questions. And please, those that are listening in and watching, feel free to just post your questions and use the time well from some experience that we have, some great experience here today. But turning to Alessandra, welcome. Nice to be connected again. I guess following up on the World of Open Accounts survey, everything we've heard so far is thinking of the responses from a provider of funding as a factoring supplier, a receivables finance supplier, or indeed a sponsor of a platform to one of those factoring firms. So I guess my question to you would be, as you're dealing with clients day to day, end users, what are your views on these matters? What are you seeing?
Well, the receivables finance business is the closest to the economy. So basically, our trend translates from their trend, from our clients' trend. And 2020 was challenging, provocative, unpredictable. We've seen, for example, a very, very good March. In March, we've had a lot of assignments because everybody was stocking up on cash. Then April and May were our worst months in years. But from June, we started to pick up, and the last quarter was the strongest that we've ever had. And we've been in this business for some time. So you were mentioning a second wave. There are some countries who are preparing for a third wave, and there is still a debate on how they will decide to tackle it, whether there will be any intervention or not. Looking at our portfolio of clients, basically we've seen some of them being a little bit more resilient than the others, and it was something that came from an acquired business behavior, let's say. The ones that did well as they were doing previously and didn't have much impact were the ones that had a very diversified portfolio of both suppliers and clients, because impact came from both ways. In CEE and in Romania in particular, we are very tied in terms of international flows to a few countries, to the UK, to France, to Italy, to Germany. They are our main trading partners. And when Italy closed, some of the companies in Romania had a big impact. They had suppliers in Italy or they had clients in Italy. So both ways were affected. The companies that had a diversified portfolio from the point of view of having public-owned companies and privately owned companies as partners, from a geographical point of view, from a number point of view, from a risk profile point of view, they remained stable. These companies that did well had a custom of using credit insurance. Also, they had a very good discipline in where expense funding is concerned. This is where the most hit were SMEs, because usually they tend to invest long term from their cash flow, and when the pandemic hit, their resources were already fully stretched, so they didn't have any cushion to go to for this period. And it's a pity, because everybody's saying that SMEs are underfunded, that SMEs are the backbone of the economy, but again, maybe in this case, due to lack of discipline, they were the most affected. But what changed a little bit over this year is that indeed we've seen companies focusing a little bit, trying at least to focus a little bit on the domestic market for both their sales and their acquisitions. They shifted at least partially from the traditional brick and mortar stores to online stores. They tried, from where we are concerned, something that affected both us and our clients was a strong increase in granularity of operations. So if a company was waiting for a week to put together all their invoices and come to the bank or submit a request to the bank, now they are doing this every day. So there is an increased workload at their level and at our level as well. We've also seen an increase in bigger companies being open to reverse factoring transactions, because they do not want to lose their supply chains. The big companies are vetting their suppliers, so they don't want to go through that process all over again if 2 or 3 or 4 or 20 go insolvent. So there is a little bit of, let's say, objective support to their suppliers, not just subjective that we owe them something. It's something that it has a big value in the long term for the company itself as well. We've seen changes in their logistic flows for the ones that do transportation, for example, for the need coming from the need to support and to protect their drivers. Document signing and pickup and so on and so forth changed a little bit, and this had also an impact on our relationship with the assigned buyers, because not having a certain signature on a certain document meant that we needed to have another type of confirmation in some cases, and the dialogue with buyers that usually would not have picked up the phone when we were calling just picked up. So this is a good outcome. Everybody, of course, mentioned the technology, and the companies that were not there yet started to make big investments in their networks and physical security wise as well, as Peter mentioned. There have been a lot of investment, and this needs to continue to stay there. But I think what nobody mentioned, and what is very, very important, is that we should not lose the personal touch, and we should not forget that, you know, behind the screen there is a person wearing a PJ or not. It doesn't matter. It's still a person.
So
you know.
Can I come back in and ask, because this is a really important point. I have probably 5 minutes left before Eric will take the mic off of me.
Yep.
I guess this is to everyone. If you put yourselves in this world of working from home, there's been a global workplace survey recently undertaken with 3,000 employees, and it's saying that over 75 to 86% said that they are saying they are more successful working from home than at work. They are feeling more productive working from home than from the office, and they want to continue to work from home at least 2.5 days a week if they could have their choice over and above what the employer wants. So for all of the panelists, I'm really interested. If you were the CEO of the company that you run, what would your decision be based on that feedback, and why? Just very quickly, we have 5 minutes. Simon?
I don't think if I was CEO, you have any choice. I mean, the businesses where I'm chairman, we fully expect to be kind of flexible about that. The challenge isn't so much the days, and it's that everybody doesn't want to come in on a Monday or Friday. People want that perception of the extended weekend, and therefore, how do you keep the right level of coverage, phones answered, etc., etc.
Just in summary, sorry to interrupt because of the 5 minutes, but you're the CEO. Someone's come to you and said, we're going to allow, or we want to allow our employees.
There's your answer, Steve. She's going to ballet and she wanted to give me a kiss. So I want to go back to the office.
A good example.
Yeah, exactly.
I'm sorry, I can't say no to that. You know, when I'm at home, I can't say no to that.
No, but this is the interesting point, okay? Because it's about, is this a point of differentiation that business owners, CEOs could use, and what other considerations would they need to consider? For example, if people don't have to travel, would there be no further, increase in payments to them on salaries? What are the considerations here, Natasha?
We have so that's really interesting you asked that. I will try not to speak too quickly because I have desire to say lots of things, and that usually translates to me speaking very quickly. I'd make 2 points. The first thing is that we are a fully remote company anyway. We always have been. But I think whilst everyone loves working from home and we do feel more productive in that sense, there is actually conversely a desire to have some interaction or the ability to have that flexibility. And I think if you do there is the problem of the Monday, Friday question. But I guess culturally, if you can get past that people see remote working as truly working at home rather than extending the weekend, it really does help to be that flexible. And people will put the extra mile in if you are flexible about hours that they work. I'm also a member of a forum that has lots of, I'd say mostly tech companies, all COOs, and this exact question has been asked on our forum about how do you adjust your benefits as a result of the fact that people are working from home? Do you start paying them regionally because they live in a certain region and they don't have to come to an office? Do you start, and the overwhelming response from that, so this is a hive mind, not my opinion, is that people should be paid for their output, not for where they live by default. So they're the overwhelming answer, I guess, for having asked a number of different people who are in control of that, is that it's a positive thing. you need incredible transparency and communication for it to work well, in terms of writing everything down about the company that you work for. But it works very well, and that you should be fair about what you're paying people for and what the benefits are really for.
Thank you. So I'm out of time almost, but I'm keen to hear from Peter very quickly what his position would be.
I want to see my colleagues 2 to 3 days a week, and the rest not. So I'm fully in line with what your survey says.
Survey, interesting. Thank you. And finally, Alessandra, I think I got your message with your lovely child coming on your lap. But just as a final.
I have 15 people in my as direct reports. They are all saying they want to go back to the office. It's I think it's easier for those that are by themselves or just with their partner at home. I think it's tougher for the people who have kids at home, because you feel like you are not fully doing your job as a parent and your job as an employee. So you, at the end of the day, you go to bed and you don't really feel happy with what you've done during that day. And that's something that people cannot live with for too long. Like I was saying, you know, I'm more direct, less
I like it.
on the personal side. So most of my colleagues want to go home. Most of my colleagues have kids. And this is one of the reasons they like the structure that the office gives. Plus, for us, at least for my team, we are in an open space, and my philosophy has always been, you know, having interactions all the time, having people know the flow from start to the end. And this allowed us in this period to reallocate resources dynamically. This really saved our asses. Sorry for that. In this period, we managed to reallocate people from one team, from one sub-team to the other. They like that, and it helps. Let's not kid ourselves. When we are all together, you identify quicker alarm signals, you handle them quicker. So this is something that I'm afraid we've kind of lost a little bit in this period. And yeah.
Thank you. That's it. Eric, apologies, I'm 2 minutes over, but I thought it was important to have that final piece of debate on the humanistic elements as well. So over to you. Thank you, everybody.
You are forgiven, Steve. No, absolutely. Thank you very much, and thank you. And please stay with us, because you may probably also have some interesting points of view concerning some of the questions. So please don't hesitate to continue to put your questions down on the Q&A feature. Well, there's a number of questions that concern the governmental support, which is related to also the findings of the survey with it. And so one person, Oliver, he suggests that maybe the feature that Natasha was talking about, large clients paying the fees for early payment to their suppliers. Well, shouldn't we try to get this done by governments who are known for slow payments? Probably a good idea. The question, of course, how to get that done, but I think that can be a question to be asked to the panel. And then another suggestion concerning governmental support would be to think about creating, or is anybody already aware of an initiative of government support that is built around a government equity investment bank, sort of a big Marshall Plan, I guess. So any ideas from the panel about new and different ways for government support? That anybody wants to take that? Maybe Simon?
Yeah, I think Europe will find it incredibly difficult to come up with a common policy for local government stroke ECB support. By the time they've worked out how to do it, we should be 2 years down the line anyhow. I think the UK has a unique problem, not just because post-Brexit, the amount of government support in the small business loan and the commercial business loan is enormous, and there's lots of fraud in it. And so I think it'll have no choice but to create a reconstitution type bank, and maybe Europe can hopefully do something kind of similar. But trying to do the equity piece in small businesses, it's possible, but it's incredibly difficult, and to generate the kind of returns. I could see some funds being created and given to the venture capital funds to deploy with a bit more of a lower risk, or sorry, a higher risk, lower return through the cycle piece. I don't think America, well, it'll be interesting with the new president. It's very difficult to say what will happen there. But over in North America, there are lots and lots of different kind of support things going already. But you know, I guess most of our audience is European principally, and I see some massive challenges for governments being able to control Europe without a UK trying to organise that, and for the UK itself, we've got billions to write off in the government support already, in my opinion.
Okay. Anybody else wants to pick up on that? Maybe Peter from Germany. Any insights on government supports and plans for government support? Maybe Euro bonds, long discussion which has been going on for a long time already, but maybe that can get into some form of acceleration now. Any ideas?
I fear that regarding Germany, we will have the elections at the end of this year, and until then, I fear there will not be any decision about this kind of, let's say, structural changes. Personally, I'm very much in favor of Eurobonds, but I fear this is a decision that will not, from the German side at least, be taken in 2021. So it's probably something for the coalition discussions, negotiations, end of 2021.
Okay. Well, thank you. Another question is, and I stay with you in the first place, but I definitely would like to go to other people on the panel as well, but it's about risk, and since you represent Atlantic Risk Management, so the question about the trading levels that are probably going to pick up mid of this year, mid 2021, but there will be then hopefully an increase in demand for working capital, but the situation of many of these borrowers, many of these applicants will be quite weak. So are we going to be in a situation which it's going to be lots of demand and not much of offering? Any ideas about that, Peter?
As I said previously, in fact, I fear that we will see a lot of insolvency in end of Q2 and Q3 2021. And generally, I think that we will see a widening gap, let's say, between the stronger and the weaker firms. But on the other hand, and I fully agree with the one that has made this question, that there will be an increase in working capital financing. But actually, I think there are opportunities, in fact, for alternative financing and AR financing, let's say, on the basis of a correct asset, is the good opportunities. I don't see this actually with the normal banks. It is for alternative lenders that can fill this gap, and that's really opportunities. And maybe the question is maybe not only AR, trade receivables, but also some other asset classes come into this area from alternative funders.
Yeah.
There's also an opportunity for here, for the smaller companies, like you're saying. I totally agree. The gap will widen, and it is going to be on the big companies to also support their supply chains. Yes. So I do think there will be an increase in demand for reverse factoring, confirming, or whatever you want to call it, supply chain financing. And this is a pretty good solution. For example, we've had several companies that are insolvent that we are financing under supply chain financing schemes, because if you have legally wise, if you have everything in order, and if you have the receivables confirmed, there is practically no risk. So as long as you are happy with the risk of the buyer, you can expand this type of financing, and this can support exactly these small companies. But there is certainly room for alternative finances as well.
Steve, you wanted to add also something to that?
Just wanted to add, fraud each year costs the economy around $5 trillion. It's a huge amount, and it's prevalent in our industry, and it always has been, during the 30 odd years I've worked in it. what I would probably advise is don't lose the good old-fashioned principles of understanding debts and debtors, the relationship between buyer and supplier. Don't over rely on technology and formulas to predict. I think use them, but actually integrate them with the human understanding of the behavioralization of books. You know, carousel fraud, collusion, you know, two-way trading, a lack of debt verification. They are all massive factors where I'm still seeing fraud today, years and years on, which were the basic failures of following the normal process of covering your position. So, you know, I think there's a balance between tech and the people still that's really important in any business to make it as risk averse or as risk protected as it can.
Mm-hmm. A little bit linked to that. Sorry, somebody.
One more thing. For us, for example, we did not change our risk approach over last year. We maintained the one that we had, and the government offered, you know, opportunities to postpone loans and loans repayment. And what we've seen is the companies that we were expecting even before COVID to default that were invoking those schemes. So it's so far the companies that were already in trouble are in trouble. We haven't yet seen the impact of COVID in terms of defaults. That will come. But exactly what Steve was saying, that just maintain the same principles. Don't get lost in the technological requirements of today, because I mean we should be able to manage if we have the right principles at play.
Mm-hmm. Maybe linked a little bit to that aspect of risk. There's a question about credit insurance. So somebody makes the observation, which I'm not really sure if it's already the case, but I would like to have the opinion of the panelists about that the credit insurance is already decreasing coverage. Is that true? I'm not certain. I haven't really heard much about that. But then the answer or the alternative would be to take more risks on the books of factoring companies for the good reasons of being close to the environment and knowing maybe even better than a credit insurer the risk involved. So what are the opinions on that quite bold statement from Rui Matsuda? Anyone would like to take that?
I mean, I can start maybe just
yes, please.
In fact, in October and November, there were, speaking, let's say, for Germany mainly, maybe a bit of Belgium and the Netherlands, main credit insurance, they have in fact cancelled or reduced credit limits in, let's say, more or less preliminarily at the end of the year, while there were still ongoing discussions whether the German government would continue granting the guarantees that they had issued. And what I heard from the credit insurance world, I would say, they were not very keen, in fact, on prolonging these guarantees because it's very, very expensive. Yeah? They pay 65% of their premiums to the German state in order to have a coverage that is never drawn, because at the same time the German state had changed the insolvency rules, which meant that no one had to ask for insolvency proceedings. So the guarantee was actually, it was a nice way to get some money. Yeah? Mm-hmm. And I'm quite, there was a lot of pressure on the credit insurances to continue, in fact, at the beginning of this year. And I cannot imagine that they will do this for a longer period than by this, I think, second quarter. Yeah, so I think, yes, there is, there will be a reduction, and factoring companies that are completely relying on credit insurance coverage, they will have a big problem, and their clients will have a big problem.
Okay. Anybody else? We have, yes, Steve, indeed.
Just very quickly, I mean, back in 2009, I was at HSBC, and we had the financial crisis on set. I had 14,000 limits dropped on me overnight by a credit insurer. And that exposed my clients, that exposed the business. I had to go to TC Re to find a 50-50 risk share to keep the business flowing and the liquidity, moving. I would say I haven't seen that type of reaction this time. I've seen more people keep limits open, but actually price up. And if I had one request of the credit insurers is be loyal to your clients today, and they'll stick with you longer in the future. And therefore, maybe now's not the time to be pricing up and putting additional pain into that process, but maybe getting a loyalty for extended terms and agreement periods with your clients is probably the better way to be doing this. Make no, the only other thing I would say is commodities have taken a massive hit recently. Trust and fraud issues around this particular part. I'm not surprised if limits are dropping away in that space in particular, until people understand, the truism of those trading documentations, throws, who are the buyers, suppliers, and how they're going to get closer to this space, because the losses have been huge.
Yeah, but I think indeed as well, and I agree that what I've heard until now is that it's certainly not the same massive withdrawals as we have seen in the financial crisis, but there is definitely something is happening. It's one of the comments from the floor is from Peter Clement at Sten, and Peter used to work for COFA, so he is very much involved also still with credit insurance companies, and he mentions that there is some difficulty in some restriction that is happening in Europe and North America. So thank you for that, by the way, Peter. So we are going maybe taking one last question, if that's okay for you. And that's the one I would like to ask to John, because Anthony Blasak, he asked John a question which is going to be answered in the next Business Money. John, you saw the question. So you are the founding father of the correlation between factoring turnovers and GDP. So Anthony says, well, instead of looking at crystal ball, shouldn't we just be looking at the GDP forecast, or is there anything else we should be looking at? John?
Yeah, well, it's quite true that if you look at the track of GDP and receivables finance since before the financial crisis to now, the two are very closely correlated. There is a clear relationship between the two, but that's a different thing from saying that one causes the other. But they are clearly linked, and that's been demonstrated at a country, at a regional and global level over that period. So I know we haven't got the year-end figures for 2020 yet, but halfway through the year, if we took the example of Europe, GDP across Europe was down 6%, receivables finance was down 6% overall, but there were bigger winners and losers in amongst all that average figure. Simon mentioned how the UK had been particularly badly hit. The receivables finance volumes there were down very strongly compared to GDP, about twice the level. But in other countries, for example, Poland, they actually managed to retain their receivables finance levels despite there being a drop in GDP. So you can't simply say that one thing will follow the other, but there is that linkage. And I think it is going to be a complicated picture because, as Alexandra said earlier in the piece, if you look at the countries, it wasn't a linear process through the year. The first 2-3 months generally were pretty good for people. The second quarter was generally pretty bad. And then there's been varying degrees of recovery for the third and fourth quarter. So we will see, I think, a mixed picture. So yes, I think it's quite fair to say that GDP, if we see GDP rising, we can be confident that overall receivables finance will rise and more strongly. And if we see a general reduction in GDP, we will see receivables finance falling. So I'm confident, I think that, the markets out there, if you look at the stock markets, the recovery has been quite extraordinary around the world. The markets are obviously looking and have the belief that overall economic value will be maintained and continue to grow. If that happens, GDP will follow it. If that happens, then I think we'll see a positive correlation with receivables finance.
All right, thank you very much, John. Well, time is unfortunately completely over. We are at our 1 hour, and in respect of that, I would like to come to a closing. I'm going to thank everybody, of course. Before I do so, of course, thank you to the participants, and would like to mention that I really, and I'm sure you with us, we hope that next year in January we will be able to meet in London for our New Year's reception. So we will also have more time and a drink to discuss what's going to happen in 2022. Now, in any case, in the meantime, don't hesitate to look at our website. We have something on digital bills of exchange in open account in the 9th of February with Andre Kasterman. We have an update on alternative finance market on the 9th of March, update on supply chain finance in April, trends international receivables finance in May, techno trends in June, and then of course we hopefully go and meet in Vienna at our physical convention, because by then 70% of the population in the world will be vaccinated. Or is that the right word in English? I'm not sure, but you see what I mean. So we are there. Thank you very much. Thank you, Steve, for moderating as always in a very professional way this panel. Thank you, the panelists, Alexandra, Natasha, Peter, Simon. Thank you, John, of course. And thank you all for taking part of this first meeting of the year. Keep well, keep safe, and see you soon. Thank you very much.
Yes.
Bye.
Yeah.
Bye.
Thanks.